Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We often hear that investing is about time in the market rather than timing the market. But still, how do you decide the right time to sell a stock? When does a quality stock go from a hold to a sell? Gaurav Sodhi is the Deputy Head of Research at Intelligent Investor and has been exploring this exact question, for a bunch of stocks. But today we're going to talk about Wesfarmers. Now, we don't normally talk about one specific stock, but we are going to today. It's a fascinating company headlined by two juggernaut businesses, Bunnings and Kmart. It also has a chemicals division. Now, remember, this is general information only and you should always seek professional advice before making investment decisions. Gaurav, welcome back to Fear and Greed.
Thanks, Sean. Nice to be back with you.
So let's talk about Wesfarmers and deep dive into it. It's a fascinating. I mean, Australia doesn't have many conglomerates anymore, do they?
No, conglomerates fell out of favour decades ago. I remember when conglomerates used to dominate the top businesses around the world, and they were out of favour for a long time. And there's a couple that have stubbornly remained. One, GE, has fallen over completely and collapsed. There's a couple in Asia that remain pretty strong and dominant, and Wesfarmers is really the only one in Australia that remains. So it's certainly an outlier.
So we'll get into the specific bits and pieces in a moment, but what's Wesfarmers made up of?
Yeah, I think of Wesfarmers not really as the sum of its parts, but as almost a private equity firm that's listed on the stock exchange, and it buys and sells businesses and it holds them for sometimes a long time. It's held Bunnings for decades, sometimes a short time. It held Coles for less than 10 years. So the aim of Wesfarmers is to allocate money to get the highest return possible for its shareholders. And that can be across any industry, across any geography, and across any time period. So there's a lot of flexibility in that mandate, and that flexibility is one of the key reasons for its success. We recently saw them go into lithium, and they're going to be starting a lithium mine fairly shortly. But the largest parts of Wesfarmers today, about 80% of profits, come from just Bunnings and Kmart, two juggernauts that people would be very familiar with.
Okay, so just before we leave this, so what you're saying, I kind of remember a guy called Michael Chaney who used to run Wesfarmers a long time ago. So it's not like they're trying to get a return on equity across like sort of a mixed return on equity. They actually want a return on whatever measure based on the specific assets they have as opposed to a mixed return on equity. Is that right?
Yeah, the way they run is that every division within Wesfarmers has to compete for capital. So that means the most successful businesses get more money. So all the cash flow from all their businesses gets pooled into Wesfarmers Corp. And then the management of Wesfarmers decides how to allocate that money. And the businesses that perform the best get the most resources, and the ones that don't tend to be sold or to be starved of capital. And that's a way of ensuring that the business generates the highest possible returns. And return on capital, return on equity, is actually the characteristic of Wesfarmers. It's maintained a 20% return on capital for decades, excluding a 10-year period where they owned Coles. And that was really an accounting story, which we don't need to go into today.
No, incredible. Okay, Bunnings. Are you a Bunnings man, Gaurav, or not?
You know, I'm actually not. I dread going into Bunnings just because my means I have to do something around the house, which I'd rather not do.
Yeah, no, I'm with you.
But I'm in the minority.
Yeah, well, it's the second or third visit on the same day that really gets me. I don't mind going the first time. It's just when I have to return things because I got the wrong thing. That's when it irritates me. Phenomenal retailing story, though. It
is maybe the best retailer in the country. And I think sometimes the financial success of Bunnings gets hidden because it's kind of lost inside this larger conglomerate. But if we break that apart a little bit, Wesfarmers has held Bunnings for decades. It started off as a rather small WA business, Bunnings, and under Wesfarmers stewardship, they've grown that from about a 4% market share, $400 million business when they first got to it. It is now a $20 billion revenue business, and it contributes about 40% of industry revenue. So it has 40% of the local hardware industry stitched up, and they still have ambitious growth targets to grow that even further.
And I mean, it's sort of seen off competitors. Masters, was it called? It was the competitor. It just seems to be going from strength to strength, Bunnings?
Yeah, when it was first rolling out, it was actually not the largest hardware store. It's actually beaten the market leader, and it's fended off lots of competitors. The most famous, you're right, has been Masters, which was a Woolworths-funded copycat, which aimed to take on Bunnings. There's a massive profit pool in hardware, and lots of companies have tried to break into that and challenge Bunnings for that profit pool, but it is so dominant. I mean, in terms of locations, these are large format stores that require specific large scale properties. And so the Bunnings has really tied up, particularly capital cities, with those properties. And because of the scale benefits they have, it's very difficult to compete with. So just an example of that. So about 90% of all the products that are sold inside Bunnings are actually distributed by the suppliers themselves. Now, a typical retail operation will hold warehouses dotted all around the country, and the retailer will buy from a wholesaler, and they'll store and inventory their goods inside a warehouse, and they'll distribute from the warehouse to the retail stores. Now, because Bunnings is so large and so dominant, they can buy the quantities and the range of goods to make sure that the suppliers are happy to warehouse and distribute for them. That means they can experiment with new products very cheaply, and they can try new things without having to invest a whole lot in logistics and distribution. And that's a key reason why they're so difficult to compete with.
Stay with me, Gaurav. We'll be back in a minute. I'm speaking to Gaurav Sodhi, Deputy Head of Research at Intelligent Investor. Okay, so that's Bunnings. Let's go on to Kmart, the second prong of the Wesfarmers retailing side. I mean, when Wesfarmers got involved with Kmart, it really was struggling. But it's turned around since then, though.
Struggling, you're being very polite there, Sean. Struggling. Kmart was considered the basket case. It was the sick child of Australian retail. This happened more than 10 years ago. And at that stage, Target was the golden child. Target used to out-earn Kmart by multiples. Kmart was mixed in with a whole bag of competition, including Big W, Reject Shop, Best and Less. There was a whole lot of discount category retail formats that were demolishing Kmart. It was actually loss-making. And Bunnings picked up the whole business for about $700 million. And the business was loss-making when they first bought it, mind you. Last year, it made about $1.2 billion. So in 1 year, they have doubled what they paid for it, and it's been a success for a long time. Now, the change in Kmart really came from Wesfarmers management. Kmart used to do what they called massive discounting. They'd sell relatively higher cost goods and a really large variety of product range, and they used to discount occasionally. And what would happen is they were very catalog driven, and customers would come in and buy the stuff on sale with the catalog in hand. And that was a formula that required a lot of capital, because there was a huge amount of logistics and warehousing involved, because they carried such a large range, and also minimized margin because people only buying stuff that was on sale. So when new management came in, they threw the entire product range away, and they went over to China, and they tried to source the cheapest stuff they could find. And the story goes that they couldn't actually decide where to get the cheapest stuff. So the Kmart executives in China just followed where Walmart was going, and they figured out where Walmart was sourcing their stuff. And they figured, well, Walmart must be getting their stuff from the cheapest supplier. So they just piggybacked on the Walmart suppliers. And they bought them straight into Australia without any wholesalers, direct importation, and they dramatically lowered the product range by reducing their distribution costs and warehousing costs, and they lowered the prices. And they didn't have any big sales. They weren't catalog driven anymore. They had everyday low prices, and that formula has been the bedrock of the success of the last 10 years or so. It's not only won them a huge amount of market share, but it's won them a huge amount of mind share. If you have children, you know that Kmart is almost the default place to go to buy almost anything for a party or for anything kid-related.
And it also has Anko brand, which is surely the most successful brand launch for the last decade.
Yeah, you're quite right. And it's not recognized as such, but you're absolutely correct. Anko is probably the most successful brand that doesn't get any fanfare. It is Kmart's own internal brand. And Anko alone is the number one toy brand in Australia, the number one pet brand in Australia, the number one home care brand in Australia, and 20% of all clothing sold over the entire country carries an Anko label. Anko has been so successful that they're now trialing a rollout of independent Anko stores overseas, and they're white labeling for larger brands as well. So it's been a huge part of the Kmart success story, and they have further potential upside for that brand still.
We are out of time, but I just want to quickly mention Target, because not everything's golden at Bunnings.
Yes, Target has been a problem, and it's mostly because Kmart has been such a success. There's probably not enough room in the market for too many of these discount-style retailers. A lot of Target stores have actually switched over and they've turned into Kmart stores, and they've reduced that store footprint enormously. The strategy for Target is now largely mimics the strategy of Kmart with slightly higher market quality and slightly higher prices. I don't think Target will be a huge part of the success. I think the two dominant brands, Bunnings and Kmart, as well as their chemicals lithium business, that's going to be the driver of Wesfarmers' success over the next few years. But it is interesting to think about the fact that that balance sheet is pretty lazy. They've probably got an extra $1 billion of capital that they can deploy in new ventures. And I wouldn't be surprised to see something, a large acquisition on the table, and maybe a divestment of potentially Target or another part of that business. It's a real strength of the company that its portfolio can change as the economy changes.
Okay, so let's go back to the beginning about when it's time to buy and sell a stock. And we often talk about buying. We don't often tell about selling. Wesfarmers itself is up about 43% in the last year. It's up about 22% this year alone. It's been on a run over the last month or so as well, certainly during July. When is it time to sell a stock like Wesfarmers? How do we know?
Yeah, you're right. It's a hard question. I actually think that buying is one skill set and selling is a completely different skill set. And we focus so much on getting better as buyers, and we don't focus on getting better as sellers. And it takes a different mindset. Now, the way I think about this, look, I should mention, by the way, Intelligent Investor Funds owns Wesfarmers, and we've held it for quite some time. The way I think about this is when you have a very high quality business, and Wesfarmers is a very high quality business, the task is not so much to buy well. The task is really to hold on, to overlook temporary dearness and try and hold on for as long as you can. Unless something dramatically bad is going on inside that business, or unless the valuation is so crazy that it's hard to ignore, you really need to look through periods like this where the stock is undeniably expensive. It's 30 times earnings. I think it is overpriced, but because there are still so many options for growth, and because this business is irreplaceable in one's portfolio, if you were to sell this, you'd be paying tax on top of it, and you'd have to find an idea that's just as good as Wesfarmers, and there's not very many of them. So in our portfolio, we've decided to hang on even though we know it's expensive. And we do that for the highest quality businesses.
Gaurav, thank you for talking to Fear and Greed.
It's a pleasure, Sean. Thank you.
That was Gaurav Sodhi, Deputy Head of Research at Intelligent Investor. This is a Fear and Greed business interview. Remember, we are not an investing podcast. This was general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.